CoffeeZilla made a very interesting video, and I wanted to look at it with you guys and then provide some additional commentary, including commentary from Charlie Munger. So let's dive right into it.
NVIDIA says we are not Enron. And as usual, anytime anyone invokes the name, I am summoned like a spirit to judge what's really going on here. All of the world's biggest companies, with the exception of Apple, have been spending billions, even committing trillions of dollars to an AI-centered build-out.
Now, this is pretty cool because you guys may remember a couple of years ago that, in fact, it was Google that fell behind on the in the AI space because ChatGPT had just come out and Google really fell behind and the share price fell as well. And recently Google has caught up. And so, I mean, from at least their perspective, the investment into the AI space has done wonders. I mean, the Google search, Google search in general is much better with AI infused into it. Now, one of the things that we were talking about is Google done forever? And there was a lot of people, I mean, the internet is the way it is. And, a lot of YouTubers were, they tend to go to the max and they were just like, okay, well, Google's done, blah, blah, blah. And one of the things that we talked about at the time was that like Google has time to catch up and they absolutely caught up. And so it was very interesting to see that happen. And then, now we're speaking with 2020 hindsight vision where Google absolutely caught up. Their search is just as fine. There's a lot of people who are not willing to pay for ChatGPT who are getting the benefits of AI in their regular Google search. And so there's an example of investments into AI that paid off.
And most of that has benefited, guess who? NVIDIA. They have basically become a data center company. You can see right here that recently.
And so effectively what he's saying here, and I mean, obviously you guys know, but what he's saying here is that the significant majority of the investment into AI is data centers because you need the compute power. And so, yeah, absolutely. What was previously NVIDIA's bread and butter, which is the gaming and the others would be like that, that NVIDIA hardware that you'd connect to your TV and then you'd be able to run media on it. That's kind of all gone away, or at least not grown as significantly as the data center side. And so my suspicion is that this just comes down, and I'll provide you guys with not absolute, but I'll provide you guys with some facts that support the fact that this spending is going to come down. But let's just continue with this video for now, and then I'll show you guys that in a second.
All their gaming PC revenue, it's basically like an afterthought. It's not relevant when we're thinking about their overall business. They are all in on AI. And in fact, our entire economy is basically all in on AI. NVIDIA, along with the hyperscalers, make up a huge portion of not only the US economy, but the entire world's economy. So what happens to them matters, not just to people building AI who care about AI, but to everyone, actually, leading to memes like this, which are kind of true.
All right, so here we go.
All the table stakes we're dealing with. You have to know that AI, and specifically NVIDIA, is a gigantic part of our economy, and our White House acknowledges that it's basically the only thing keeping us from a recession right now. With most people feeling like they already are in a recession because of their earnings being stagnant and because of inflation ripping. But I want to talk about NVIDIA's response, because obviously that sets the stage for the "we are not Enron" claim, because there have been questions boiling up.
Now, Enron was about, it was about like derivatives, fraud, etc. I don't think anybody is saying that, anybody I would say that's relatively intelligent, and that might be saying too much, but my thoughts are like, if anything, what I would say is, maybe I'll answer this with a story. So you guys may remember, some of the older guys like myself may remember the dot-com bubble. In Canada, there was a company, and it still exists, it's the largest bank in Canada, the Royal Bank of Canada. And what the Royal Bank of Canada started doing, rightly so, is they started closing down many branches because they thought the significant majority of customers will start doing their banking online. They were not wrong. They were just 10 years ahead of their time. Customers did eventually start doing a lot, if not most, of their banking online, but that didn't come until 10 years later. And my thinking around the investment into AI is that in a lot of cases, I think people are expecting way more to happen much sooner than it's actually going to happen with. I think overall, I mean, I've given you my thoughts on AI before. Overall, I think AI is I would say a marginal improvement in productivity, and over time that margin will continue to increase and increase. But you're not going to get mass layoff driven by AI anytime soon, at least in my opinion.
About all of this investment, is it worth it? Is anyone doing anything suspicious? So we saw NVIDIA sent a report to certain outlets basically fighting back on the FUD. And two of their source documents were a guy on X, aka Michael Burry, the guy from The Big Short, who's recently been criticizing them, and another article which said the algorithm that detected a $610 billion fraud, how machine intelligence exposed the AI industry's circular financing scheme. Now, I want to specifically talk about Michael Burry because he's the main thing they're responding to. He has been kind of shaking up the industry with an interesting critique that I don't think a lot of people have focused on. So far, a lot of the criticism about AI bubbles has been that AI is not as impactful as we thought, or that it is being overhyped. But Michael Burry...
Both of those are true, by the way. AI is not as impactful as people have thought it would be, but the reason why is because I feel like it has been overhyped by not the people in industry actually using AI, but overhyped by people who are not in the industry. Okay, and so here's where we go into his Substack.
Articles he's been putting out. He's recently become a blogger, a bit of an influencer recently after he shut down his hedge fund. And so now he can publicly comment on these types of issues. Now, I'll obviously link below to his articles, but understand they are paid. I think it's like $390 for the year. So I
tell me if you guys are paying for it. I'm definitely not paying for his articles, but let me know if you guys do have access to them.
I bought it for you, so you don't have to. I'm going to be talking about it, but let me just say he's a great writer. I'm not going to feature much of it because obviously it's paywalled stuff, but I just want to give you the basic arguments so we can talk about the implication of what NVIDIA is really so worried about. So the first thing Michael Burry lays out is a primer on the dot-com bubble, which he calls a supply-side gluttony. And
that makes a lot of sense, right? If you guys think about what happened in the dot-com bubble, a similar thing happened where everybody invested in, I would say, the digitization of the economy, but the customers didn't come right away. It took time for it to get there. And by the way, I will say that this just keeps rhyming, this notion of overinvestment. If you guys remember, after the lockdowns, a lot of the internet-based company, like media-based companies, they overinvested in the digital economy because they thought that, when customers were, or when people were locked down at home, they were using, for example, YouTube more often, they were using online shopping more often, et cetera, et cetera, et cetera. And what ended up happening is these companies started to get higher valuations, they started reinvesting into their businesses, and then once everything reopened again, the growth of the digital economy returned to its historical growth rate, and there wasn't a pull forward like what we thought. I mean, even people like Jim Cramer were saying, hey, this is just a pull forward into an inevitable trend. And then, of course, that didn't happen. It just went right back to its historical growth trend, or its adoption trend. And so AI adoption trend or loop or whatever, it sounds very similar to that. And so what you'll end up having is people are not perfect. They'll overinvest and there'll be times of underinvest, etc. And I think it'll just go up and down like that. But overall, the AI adoption curve will follow a natural adoption trend, just like the digital economy did.
The main thing he lays out is the idea that the original dot-com bubble from 1999, 2000 that everyone remembers is sort of misremembered. It's sort of like one of these Mandela effect things where everyone's collective memory is not quite what really happened. If you ask your average person, if you ask even me what the dot-com bubble was.
If you guys don't know about the Mandela effect, look up Bernstein Bears. Yeah, just look that one up.
about, I'd probably mention something like pets.com, some of these .com businesses that had no revenues and basically were complete vaporware that were trading at massive valuations that didn't support anything. And this is what the AI defenders say when you bring up the .com bubble, the massive amounts of spending. They might quote someone like Jerome Powell, who says that unlike the .com bubble, AI spending isn't a bubble. Quote, I won't go into particular names, but they actually have earnings.
Now, that's kind of BS because, I understand the younger generation who didn't really live through it. I mean, I was even young. I was in high school at the time. But, I remember, Amazon was a book retailer back then. They had revenue. I don't know if they had income, but they definitely had revenue. Microsoft was a part of the .com bubble as well. It's not like Microsoft went away. The thing about it is that there's a shakeout when these things happen, right? There are companies that are involved in the technology that have marketable visions and they have a vision into marketable products with real revenue, and then there's companies that don't. And so it's not like every company has zero revenue. It's that there will be winners and there will be losers. And it's our responsibilities as investors to figure out which ones are going to be the appropriate ones. NVIDIA is a real winner in the chip space. But I will say the chips business in general is a very tough business. And it's tough because the economics of the business don't support, throwing tons and tons of cash at the investors. At least that's been my opinion. Charlie Munger also shares that same opinion. So let's listen to Charlie Munger talk about investing in the chips space. This is something that I do remember I talked about years ago when this interview was new, but I'd love to bring it back up again. And this is, again, one of the reasons why I personally don't invest in the chip space. I don't care if NVIDIA goes up 50x. It doesn't matter to me or my portfolio.
How should we think about the political climate around Taiwan and the long-term impact on the semiconductor industry? Specifically, do you see the Chips and Science Act favorably?
Well, the semiconductor industry is a very peculiar industry. In the semiconductor industry, you have to take all the money you've made, and with each new generation of chips, you throw in all the money you previously made. So it's compulsory reinvestment of everything if you want to stay in the game. Naturally, I hate a business like that. At Berkshire, we like a whole lot of surplus money to come in that we can do something else with.
And that's exactly it. That's the big point about investing in AI. Now, it's one thing if you have such a lead on your competitors that you can charge large premiums so that you do have surplus money coming in, as Charlie Munger was saying, but they don't. That's the thing. Google is right on NVIDIA's tail as it relates to developing these chips, and they're also getting strong competition from China. May not be at their level, but it's definitely getting there. So the point is that if NVIDIA takes their foot off the gas pedal, they will fall into second, third, fourth, fifth place. And so this is where it becomes tough investing in this space. It is a very, very hard business and not easy for me to predict what the next 20 years are going to look like. And so if I can't predict what the next 20 years are going to look like, I'm not going to invest it for the next 20 minutes.
Now, if you're enough ahead of it, like Taiwan Semiconductor is, that may be a good buy at these prices. It's not at all clear to me that they're not going to succeed mightily, but it's a difficult. It's a business with enormous promise for the big winner. But it's a difficult business in requiring everybody to keep increasing the bets on and on with all the money. And so it's not perfect, that semiconductor business. But remember when Intel owned the world? Intel was once the Taiwan semiconductor business of the world.
Yeah.
They invented the damn business, and they dominated it for decades. It's not clear to me that Intel's going to have a very decent semiconductor business getting as far behind as they are now. My answer is it's not so damn foolproof as it looked.
Even with the incentives to build plants here in the United States, like Intel is doing in Ohio? Well,
of course, that will really help. But they're borrowing the money. There's no indication the government is going to forgive the loans or something. It's not like the recent loans to business where they said, we'll loan you the money, and then it was a way of having, go keep the money. The government is not planning to do that with these new semiconductor loans. And so look, it's not a field where I feel I have a lot of expertise.
And same here, to be honest. And so with that, let's go back to CoffeeZilla.
The idea being that back in the pets.com days, the Ask Jeeves days, there wasn't actual revenues to support the valuations. Unlike here, you actually have companies like Google who are making tons of money. So it's just kind of not the same thing. And Michael Burry argues that that's actually not true, that the dot-com bubble was a lot more about overbuilt infrastructure from companies that were profitable.
Nailed it. In my opinion, I think Michael Burry nailed it. It was absolutely overbuilt infrastructure. Couldn't have said it better myself.
Specifically, he brings up Cisco Systems, which was one of the most valuable companies in the year 2000, and specifically was valued based on a lot of their interconnecting equipment sales for the internet.
That's right. So for those of you who aren't aware, Cisco, at least at the time, their bread and butter business model was connecting everyone to allow the internet to grow. And so they were effectively the bridge operator. And so the more roads you're connecting, which is effectively the internet, the more profitable you will be. And so it made a lot of sense that Cisco would be one of the largest companies in America in the late 90s for sure.
The future, basically. And a lot of the narrative at the time was that the internet is the future, so you have to invest massively in infrastructure for the future. And because of that, there was a massive overbuild. And that all blew up when there just wasn't the demand to meet the supply.
And what he means by blowing up is, I don't know if he's going to go into it. I don't remember. I have pre-watched this one, but I just can't remember. But Cisco had to write down a ton of inventory because the demand just wasn't there. Now think about that from the perspective of an NVIDIA. What happens when the when the investment goes away? Now, they may not necessarily have a ton of inventory because they're probably selling everything that they do have. But if those revenues dry up, then what about all the investments that they've made into R&D, et cetera? Like how much of that stuff gets written down? And so that's a challenge. Now, it's not just going to be NVIDIA, right? Because there's a lot of companies who are making tons and tons of investments into the AI space. If the demand isn't there, then do we expect massive write-down? Now, I'm going to pause CoffeeZilla there because I think right now is a good time to show you what Gartner thinks about demand in the AI space. So here, I just Googled Gartner AI revenue recognition. Now, the only reason why I know that this exists, by the way, is because I've been feeling like, and you guys know, I'm an operator. I'm an executive in the finance space. I have been feeling like I've been behind on this whole thing. And I've been going to these AI conferences all over America, Canada, etc. One of the things that I've been doing is I've been talking to all of these CIOs or tech leaders, Gartner being one of, a consulting company that focuses basically on the future. When I was talking to the gentleman over from Gartner, the comment he made to me is, do not feel like you're behind. The fact that you're coming out to these things and you're trying to learn means you're probably more ahead than most people. The thing is, everybody's just pretending. And this is what he mean, or not pretending might not be the right word, but everybody is sort of kicking the tires, but you are not wrong to not see a life-changing path with AI. I think that's the right way to explain it because I don't want to misrepresent what he said. And so this is along the lines of what was said to me, is that the most common initial beliefs of AI adoption is that, the most common initial benefits of AI adoption are productivity gains and cost savings. This absolutely, I agree with. With the adoption of AI, I'm seeing productivity gains for sure. We're able to do more with less, that's for sure, but we're not, replacing full roles. With automation, maybe, but that's not an AI-driven automation. That's more like finance system automation, but not AI itself. And so what this is saying is that this is sort of like future financial value rather than immediate direct revenue. That's right. This is more impacting the bottom line than the top line. So there is no revenue generation from us being able to be more productive. Now, maybe if you're able to loop that productivity gain into your sales force, then your salespeople can, close more deals, and then so maybe that is a direct impact on revenue. But again, that's more value down the road because it takes time to adopt that, build it, learn best practice, etc. Now, here's the challenge. CEO expectations versus reality. Over half of CEOs expect to see AI-driven profits within the next 12 months. So profits, my thoughts is that's bottom line, okay? That might not be, but only less than 30% of AI leaders report that their CEOs are happy with the AI investment return so far. That makes a lot of sense because even when I went in and I invested into the AI space, my initial thoughts was, let me do a very low investment and see what this actually is. And we basically layered on an LLM on top of our financial planning and analysis platform, and the results were great, but they're not life shattering. And so for the investment, it absolutely made a lot of sense because the investment was tiny. But imagine if you put in tens of millions into that, and all you got was the ability to query your database, and it might the answer might come maybe 5 minutes faster than what it normally would. That's still a good benefit, but is it worth I would say 8 figures of investment? I don't know. I guess it depends on the company, to be honest. Gartner goes on to say, or at least in the Google search, it says that Gartner predicts that 30% of Gen AI products will be abandoned after the proof of concept stage by the end of 2025 due to issues like unrealistic expectations. And I believe that this is relevant: governance challenge and skill deficiency. So unrealistic expectations are, we expect for the AI to do way more than it can. Governance challenges are basically just, can we keep our data safe, and can we, hallucinations matter, right? And so if the data, if the AI system is hallucinating and not giving you the right answers, that's a problem, especially if you're using AI to write disclosures that go out to the public or to customers or to management that make decisions based on them. So governance challenges are a big problem here. And then skill deficiencies, where do you have the right people in your company to manage these systems? And so, Gartner emphasizes, sorry, I can't say that word, that organizations should focus on the AI's ability to drive long-term strategic value and workforce transformation rather than expecting immediate massive revenue spikes or even profit spikes, in my opinion. And so that's where I actually think that the AI might actually be overhyped to an extent. And I guess it's enough, if 30% of the projects are going to fall, that's enough for it to be material, right? And so if 30% of the investment in AI is expected to drop off, then that original sort of curve that you saw from NVIDIA, does that drop off? And if it does, then you're absolutely looking at a bubble. It's not a fraud-related bubble, so they're absolutely not Enron, but it absolutely can be a demand side challenge where you're oversupplying demand that's probably going to incrementally increase but not come all at once, which is a very, very, very clear echo of the dot-com bubble.
And everyone had found out that they had overspent on a bunch of infrastructure that wasn't going to be used. So Burry says, hey, look, these dot-com companies that everyone likes to cite, they weren't big companies, big players in the game. The biggest players who were leading the large cap did have revenues. It was just all based on an overspend on infrastructure. And he argues the same thing is happening with AI. I should also mention there's a lot of talk about the WorldCom scandal, which is basically a telecommunication company. And their big thing was essentially accounting fraud. They basically moved line items from the expenses category to the assets and made it seem like they were more profitable than they were. Okay, so
now he ran over that, but really, for those of you who are not, into the debits and credits, basically what happens is for every debit, there's a credit. Now, for expenses actually fall on the debit line. And what that's saying is it's going to go through your profit and loss statement today, so it makes your income look lower. Or what you can do is you can actually take the expense off and debit to your fixed assets. And what that does is the fixed assets amortize over time. And so there you can play some games, right? You can effectively make your profit and loss statement look higher by not having those expenses go through your profit and loss statements today. And what you can also potentially do is draw out the time that they get amortized, which is, say the asset has a useful life of really like 4 years, but you say, and this example will be relevant by the way, but say that the asset has a useful life of 4 years and you say it's got a useful life of 8 years, then you're impacting your profit and loss statement by half the amount per year, because it takes 8 years to write that off, or not write it off, but amortize it through your P&L versus the 4 years that it would normally take. But really, if it was a true expense, 100% should have gone through in year one. And so I just wanted to nerd out on the accounting side for you guys just for a little bit.
So to zoom out, what does this all have to do with NVIDIA, right? Why are we talking about the dot-com bubble? Well, Michael Burry is basically making a two-pronged case so far, which is one, that there's a ton of overbuilding on supply, just like there was for the early internet, that's not necessarily tied to any revenues, and that's going to become a huge problem. And secondly, he thinks there are some accounting tricks that are happening that is basically overstating revenues, and this is in his next post.
Okay, and let's go back quickly where that image was. He zoomed in. Let me see if I can get back to it.
Accounting tricks that are happening. That is basically.
So here we go. So depreciation change on GPUs. So in 2017, it looked like Amazon was depreciating them at 3 years, which makes a lot of sense. I would say anywhere between I'd say 4 and 5 years is probably where you depreciate them. Everyone's getting to 6 years now. Personally, I don't think that that's a huge problem, because if, there's a couple of ways to look at it. My take on that would be, if you're doubling the useful life of these GPUs, it might just be that you're building these things out as quickly as you can, these data centers, but each data center, you're probably just going to keep the GPUs in for longer because there's restricted supply. So it makes a lot of sense where you will just have data centers that the GPUs don't get swapped out for 6 years. So it absolutely does make sense. However, it doesn't make sense if you're just doing the same thing that you've always done. And you're swapping these things out while you're still keeping them on your books. That would be absolute fraud. And so, this becomes a big audit issue, and my suspicion is that the auditors are on top of it. And if they're not, then what you have is auditor collusion into this as well. Now, what's an easy way to sort of get around this? Value the companies based on their cash flow statement. I would say, if you guys remember when Facebook or Meta was investing into the metaverse, we actually switched the way that we were valuing the company. We were actually valuing it using the cash flow statement, and we're just assuming that a portion of that spend, of that capital spend, is just wasted capital, and so we just gave them a lower valuation. A lot of smart analysts will probably do something similar here, but because again, amortization policies don't impact your cash flow statement, but they do impact your P&L. So just keep that in mind, that there are a lot of smart analysts who are probably just working around this and just using their cash flow statement to value these things as opposed to their P&Ls.
Basically overstating revenues. And this is in his next post called Unicorns and Cockroaches, Blessed Fraud. This is where he takes a deep look on the depreciation of GPUs. Now, GPUs are basically the lifeblood of NVIDIA. This is what they're selling primarily to these data centers. This is what's doing a lot of the AI compute. And recently, there has been an accounting change in how these things are depreciated. Basically, several of the major companies have been shifting their depreciation costs on GPUs from 3 years to about 6 years, or 4 years to 6 years. And this basically has the effect of increasing stated earnings because you are depreciating slower. So if you lengthen the amount of time that you can depreciate something over, your earnings during those years are going to increase. And the problem, of course, is if the actual life cycle of the thing is not as long as your depreciation schedule says it is, because it will make investors think you have assets that really aren't assets, basically.
That is fraud, though. And so, again, you're going to have auditors sign off on your financials over that fraud. That's where, it's tough for my head to sort of think about that. Now, the one benefit, I guess, of me commenting on this is that I was an auditor. I audited for a Big Four company in the past, and this is an easy fraud to catch, right? Because you get what's called a fixed asset continuity schedule. So basically, everything that has been capitalized, and so you can actually trace the assets with the serial codes right to the facilities. And so, if an asset is not being used and you're looking at the continuity schedule and you see that the asset exists on the continuity schedule, but then you do a fixed asset, effectively like a count, you'll like, if you don't see the GPU like in existence and being used, then you automatically know that that's a fake asset on the continuity schedule. So like, this is something that is being audited, and it's easy to catch the fraud, at least in my opinion. And I think because there's heightened risk over it, because Burry's talking about it, it's not like the auditors are not aware of it. It's not like they wouldn't put additional procedures over it. So I don't know. And again, I might be wrong, right? But it just doesn't make sense in my mind that this wouldn't be caught. And I would think that before changing amortization policies is such a big deal in the accounting world that I can't imagine the auditors not giving sign off before the policy got changed.
Now, I should say, not everyone agrees this is a mistake. Some people say that there's a justification for this, that several of these old chips are actually being used in what's called inference for these AI models. But today I want to take a look at that, because that is where I think Burry's arguments cut the most true. I don't see why we think GPU life cycles are going to be longer instead of shorter in today's age. I don't think there's any evidence for that. And that leads to Michael Burry's whole argument. He says, responding to NVIDIA's claim that they are not Enron, quote, "I am not claiming that NVIDIA is Enron. It's clearly Cisco."
That's a hilarious line, by the way.
And this is obviously referencing the idea that the criticism here is that this is an infrastructure overbuild out. All this commitment for massive, massive, massive data centers, the likes of which we've never seen.
See, imagine 30% of the spending falls off. That'll be a challenge for NVIDIA. So like, if you're going to short NVIDIA, I understand why you would short it. I mean, I'm not going to invest in it, nor am I going to short it, but like, I can see why you would want to short it.
Seen before there is revenues to support it for the hyperscalers like Google, Amazon, Microsoft. It just doesn't make sense. And that's his argument. It's not a question of whether AI is real or not. It's just a question of, do you need this before there is demand for it? But now we're going to dive deep into this criticism of depreciation. Basically, these GPUs are not valuable past a few years, or are they valuable for 6 years? Because NVIDIA said in their whole response to Michael Burry and the haters, they said, rebutting this claim, some companies have increased useful life estimates to reflect the fact that GPUs remain useful and profitable for longer than originally anticipated, in many cases for 6 years or more. But this, even for me, rang very hollow, because I've seen podcasts where the CEO of NVIDIA is talking about how they're not slowing down the pace of development. They're actually accelerating it. And they're actually introducing an annual cycle for putting out new chips now, which is faster than ever before. So if anything...
But again, I don't think that like, at least in my opinion, I don't think that that's a reason why the depreciation would, like, the assumption there is that the company is doing an annual refresh on all of their GPUs, when really it's that the new data centers that they're building with the chips that they can get their hands on are just better than the data centers that you built 3, 4, 5 years ago. But over a 6-year refresh cycle, those old data centers that are physical locations will just get fitted with the latest and greatest chips, and you just kind of keep going through all of your data centers all the time. Like, basically, every year you're refreshing a fractional amount of them. Now, am I wrong for thinking that? You guys let me know.
The pace at which your GPUs will become outdated is not slower than before. It's actually arguably faster than before.
So the first thing is, because the token generation rate is going up so incredibly, 2 exponentials on top of each other, we have to, unless we increase the performance at incredible rates, the cost of token generation will keep growing because Moore's law is dead, right? Because transistors basically cost the same every single year now. And power is largely the same. And between those two fundamental laws, unless we come up with new technologies to drive the cost down, even if there's a slight difference in growth, you give somebody a discount of a few percent, how's that going to make up for two exponentials? And so we have to increase our performance annually at a pace that keeps up with that exponential.
Now, I want to pause here because basically what he's saying is we are accelerating in order to keep pace with the demand. But this acceleration also means that if you previously, your GPU would sort of become irrelevant in several years, it's actually going to become irrelevant even faster now. And you can kind of see here how the performance of some of their products has increased over time and decreased the amount of energy you need to generate a token. And that's going to become really relevant because, as you'll see, part of the problem for these data centers is the cost per watt. Basically.
Right. Okay. So that makes a lot of sense. So I think what they're saying is that from an efficiency perspective, if you're not refreshing sooner than, if you're not refreshing each data center sooner than once every 6 years, your data centers become increasingly inefficient. And so you should be refreshing them more than every 6 years, which makes sense. But across a portfolio of data centers, can you have certain data centers that are focusing on tasks that are less intensive than others? I don't know. I'm not a technology guy. And so it still sounds to me like it's not fraud, but I might just not understand as well as you guys might who are watching this video. And so again, let me know what I'm missing out on.
Basically, the electricity cost fundamentally is what you're pushing against. And so as these GPUs get more powerful or get more efficient per watt, then you're going to have to replace it. Otherwise, you're just not competitive with the general marketplace.
But my thoughts are, in order for you to not be competitive with the general marketplace must be refreshing all of their data centers every year, which is not happening with the majors out there, the AWSs, the Microsoft, Google, etc. Like, it's not happening. Or at least in my opinion, it's not happening. It doesn't make sense to me that it would be happening. Based on their financial statements, it's not happening.
Alongside that, now we can listen to Jensen explain why this performance increase eventually means that other people's GPUs are literally not worth running because they're so much less efficient than these new models or new GPUs.
Some people where you say, our competitors building ASICs, they could literally, all their chips are cheaper already today, but they could literally price them at zero. Our objective is they could price them at zero, and you would still buy an NVIDIA system because the total cost of operating that system, power, data center, land, etc., the intelligence out is still a better bet than buying a chip, even if it's given to you for free.
Because the land, power, and shell is already $15 billion.
Right.
Yeah. Let's just think about it from a perspective of revenues.
Yes.
Okay. So everybody's power limited. And let's say you were able to secure 2 more gigawatts of power. Well, that 2 gigawatts of power you would like to have translate to revenues.
Yes.
So your performance or tokens per watt was twice as high as somebody else's token per watt.
And this is where I'm very sympathetic to Burry's argument, where NVIDIA sort of wants to have it both ways. They want to have a long lifespan for their products, but they also want an insane annual cycle pace.
And I think that they can have it both ways, at least in my opinion, because it sounds to me like, I still keep looking at this from an overall portfolio of data centers that each of these companies own. Some of the data centers are just going to be newer, they're going to be more powerful, and others are, they will have been built years ago and will be less efficient. But as time goes on, you'll upgrade the chips in those data centers. Now, the one thing that does make sense to me, and if I'm playing devil's advocate, is if you have an insane amount of capital and you're in an AI race that all of these companies are, why would you wait the 6 years if you have the capital to refresh your data center? Why wouldn't you just refresh it now? And if that's the case, then you do enter into a place where you're amortizing these things a lot slower than you should be. And so that's where I see the argument that Michael Burry is making makes sense.
Which is accelerating ever faster. And literally they're saying, look, you can't even buy our competitors' chips because performance per watt, it's not even worth running them. But you can also say if they keep increasing the pace of their development this fast, then they're actually cutting against what? Their old chips too. It's not just their competitors' chips. It's their own chips are not worth running. And so that.
Now, by the way, that's been a challenge for a long time. How many of us have bought computers with really strong NVIDIA chips only to see those chips way outdone by the newer chips that have come out? And so, like, I think that's just natural.
That's the whole argument for this depreciation cycle not making sense. And if it doesn't make sense, what happens to everyone's earnings? All these hyperscalers.
Again, I don't think it matters because, this whole depreciation controversy, if you want to call it that, starts and ends in the P&L. And so if you're valuing the companies using the cash flow statement, which is what you probably should be doing for these very capital intensive companies, then it's going to be irrelevant anyways.
Well, they would be overstated. They actually aren't what they thought, and they are much lower, which would mean that their market price would go down. So ironically, NVIDIA is sort of cutting off the very tree that they're standing on, in part because they are making their chips less useful faster because of their development pace. Now, the question, of course, is, well, can they slow down? Not really, because Google is right on their heels with Gemini 3, which...
That's right. They're not that much ahead of their competitors, which goes back to Charlie Munger's comment about this is why it's tough to invest in the chip space in general, because you take all of your profits and you have to put it right back into R&D to keep this keep the development going.
They supposedly developed with just their in-house TPUs, which, funny enough, the NVIDIA newsroom actually commented on, saying, "We are delighted by Google's success. They have made great advances in AI, and we continue to supply to Google. NVIDIA is a generation ahead of the industry. It's the only platform that runs every model and does it everywhere computing is done." But within this, a lot of people sensed a cope. They were trying to just kind of reassure everybody, hey guys, we're still the best, right? But the question is, are they going to be the best forever? And so they really can't stop the pace, which ironically is going to hurt their customers who have to constantly cycle through these chips in order to be competitive with the rest of the industry. I should also notice that there are also cheaper open source Chinese models that are getting quite good. There's something called Kimi K2. And the question ultimately is not whether AI is a thing, at least not according to Michael Burry, but rather whether NVIDIA is worth all this capital expenditure, whether it makes sense, whether they are overbuilding, whether a company that is primarily valued on their data center revenue, whether those data centers are going to make money. Because if it doesn't, basically our entire economy is built on this.
Yeah, and I think, and we'll cut off there. I think overall, just from my perspective, based on the Gartner research, I think people who are doing it right will reap benefits from AI adoption. But I think that Gartner's probably right in that like 30% of these projects are gonna be shut down. And so the here's how I'll predict the NVIDIA space. If I'm gonna make a prediction, again, I'm the wrong person to be predicting anything on tech like this, but I would say that 10 years from now, or maybe 15 years from now, give myself a lot of time, NVIDIA is going to be selling better and more chips than they are today. In between that, there might be, an up and down. Will NVIDIA make $1 of true earnings to owners in that time period? I don't know. And that speaks more to the economics of investing in chip makers than it does, what the future technology looks like. And then I think, AI adoption will become better because people will know how to invest in it appropriately, how it works for their organizations. And so I think you might be in a short term, like if I were to call it, I think you might be in a short term blip in terms of more supply than demand. But I think over the long term, the demand does catch up because I do see benefits coming from AI, and I think it does make us faster, better, smarter, etc. And so I'll leave it there. Let me know what you guys think in the comments below. Extremely grateful for CoffeeZilla to put this video together, and I will provide the link in the description of this video below for you guys to go directly to his video to watch it yourself. Okay, I'll leave it there. I'll see you guys later.